There are a couple of things that are going to drive the markets, we think, with the Biden administration and the Democrats taking control of the White House. The first one is that we think that they're going to push the fiscal support agenda post-COVID pretty hard. And this will be all sorts of things that they do to put money in the hands of different individuals in the state. So it's going to involve direct payments to households, small business support, and federal unemployment benefits that will come through. If the Democrats had their way, the extent of that support would be between $2.3 and $3 trillion. It is an immense amount of money. I mean, it's 11 to 15% of GDP that effectively is going to end up in the hands of individuals, businesses, etc., in the states to push growth into 2021 and 2022. If the Republicans had their way, it would be a lot lower, and this is where the impasse sits. They're probably closer to 500 billion, and this is where the Democrat control of the Senate becomes very key. If they don't get control of the Senate, and I'm going to go through a little bit around that in the next slide, it'll probably be at the lower end. Having said that, there is going to be, we think, some stimulus even at the low end that is going to come through into the early part of next year. The other thing from a Biden perspective is this huge commitment to going green, doing all things green related. That's a further $2 trillion that's going to be spread out over 4 years, but that's kind of 10% of GDP that's going to go into the market and help push real businesses in the US over the Biden presidency. There will be increased infrastructure spend. It's one of the key components of his of what Biden stood for. And we think over time that there are going to be improved relations with China. I guess they couldn't get much worse than the Trump era, but there probably will be improved relations with China. I'll show you in the next slide that the relations actually with China have improved quite significantly, even with all of the Trump rhetoric. We think that in combination, most of the policies that Biden has point toward a weaker dollar. And that is one of the key themes that Murray in particular in his part of the presentation will talk to. Here's a quick slide to show you what I mean by the improvement in relationship between the US and China. Look at the red line in both of these graphs. The top graph is exports, the bottom graph is imports, and you'll see I've based it back to 100 in 2010. You now see that certainly from a US export perspective, a lot going into China. And here with the Trump years where they encourage people not to import from China, we're back to basically where we were previously. So those relationships have already thawed, and we think will continue to thaw in the Biden administration. So Joe's won, but now what happens from a Senate perspective? And it's quite an interesting situation. I'm sure a lot of you have spent as much time as I have watching CNN and trying to understand the US political system. Certainly not the easiest to understand. So Georgia's state law requires a runoff if no candidate gets more than 50% of the vote. And there are two candidates in the race for the Senate that didn't get 50% of the vote. So there will be a runoff on the 5th of January, which is 9 weeks after the election. 3 weeks of early voting is going to be allowed, and then I've given you the names of the people that will be running against each other in those elections. So all of a sudden, these Republican and Democrat senators hold a very key element of what happens going forward in the US. If both Democrats that I've highlighted there, John Ossoff and Raphael Warnock, win their seats, then you end up with a tied Republicans and Democrats in the House, both having 50 seats. And then Kamala Harris as vice president has a tie-breaking vote, and then it's basically blue wave. If the blue wave happens, that huge stimulus will take place, and pretty quickly in our view. We have no real view, no real political expert as to how things will play out in Georgia, but I guess we are hoping for that blue wave to happen. So Mike has just put up who you think will win the runoff in Georgia. We're going for Democrats our side, so you can submit your vote and we'll show you what the result is a little later. I've shown this chart in a number of the webinars that we've done up to now, and I updated it. In fact, I updated it on the weekend and then had to update it again during the course of the week because of the big moves that we've seen in the markets over the last couple of days. The top line here is the current, I guess, downdraft that we had as a result of COVID, and actually phenomenal recovery that we've seen in the S&P 500 relative to all of the other big downdrafts that we've had in the market, or big crashes that we've had in the market over time. So it's been a very, very solid recovery that we've had, and there's been a lot written about it. Those that have listened to previous webinars would also be familiar with this chart, which I had to update literally when I was updating it. I think it was on Monday. The chart was literally moving before my eyes as the market headed up over time. So I updated to the close of Tuesday. Some interesting things to note here. So this here is the domestic South Africa index. That's the pure domestic businesses in South Africa. And what's interesting to note is that although we're in a fairly rough time in South Africa at the moment, the recovery since the lows of domestic South Africa is basically in line with the MSCI World. We haven't done too badly. If you look at the Cap Swix, which is the orange line, which we think the Cap Swix is the best representation of the South African equity market, it's actually done a lot better than the S&P 500. And if you've been in either the Rand hedge or the international stocks that just happen to be listed in South Africa, it's been an absolute phenomenal recovery since the lows, and particularly over the course of the last couple of days. One of the things that we spend a lot of time thinking about as South Africans is the Rand. And we watched very carefully yesterday as the news hit the news wires of the potential Ace Mogashule arrest taking place. And the Rand actually, although I would have thought it would have reacted, basically didn't react. I'm making a bit of a point of this. It's not and the point that I'm trying to make by making this comment is that often we think in South Africa that the Rand is a real function of what goes on in South Africa. It is to a certain extent, but one of the things that one has to watch very closely is the attitude of international investors to emerging markets. And that's best seen through the emerging market bond spread, which JP Morgan puts together. And that in this chart is the red line. And you'll see a very good visual correlation between the movement in the Rand and the movement in emerging markets. So we spend a lot of time trying to understand that emerging market sentiment, and that's what is to a large extent what drives the Rand. In a weak dollar environment, we think that emerging market sentiment is probably going to be strongest, and that's one of the things that could potentially drive the Rand even stronger than where it is at the moment. One of the trades that we've put on over the course of this year in our asset allocation funds, our balanced fund, our stable fund, and our flexible fund, is to switch out of the S&P 500 and into the Russell Value Index. And there are a couple of reasons for that. I'll talk to some of them, and Murray will mention some in his component of the presentation. We've gone back to basically crisis time here, so emerging from the crisis, and just graphed the price performance of Russell Growth versus Russell Value. It has been phenomenal, the growth versus value. If we then look at it from a valuation perspective, and I've done a PE relative chart, so I'm graphing the relative of value to growth, you will just see how over time, I based it to 2009 at 100, over time, how value has just continued to lose ground to growth from a valuation perspective. And as a result, at the moment, to us looks very, very attractive. One of the things that has also driven this growth value move that we've made is not just liking value, but being slightly concerned about what goes on in the growth component of the market. Now, these big companies here, you all know as some of the bigger growth companies in the US. They're the stocks that have driven the performance of the S&P by and large over the course of this year. And what I've graphed here is the tax rates that they paid in 2016, so before Trump came in, and the tax rates that they're paying now post-Trump coming in. One of the key things that Biden has mentioned he will do is increase taxes, and increased taxes effectively would basically take these guys in broad terms back to that fiscal year of 2016. that could be a huge headwind for some of these big growth stocks that have had the great tailwind of COVID behind them. So this is one of the other themes that we've been thinking of and has played out in our portfolios. Finally, this presentation wouldn't be complete for me if I didn't talk about what's going on with respect to COVID. I guess I've noticed, certainly in South Africa, and maybe you have as well, that people have become a lot more relaxed about what's going on with COVID. We're obviously at level 1, and I think there's, I guess, a bit of COVID fatigue settling in. And there's a good reason for that. I mean, if you look at our active infections, so in fact, people are actually infected at the moment with COVID, we're running at 643 people per million population. Not too bad. But I'd just like to point out, if you're sitting in Belgium, France, Spain, the US, these are active infections per million population. This is, it has not gone away. There are significant infections taking place in other parts of the world, and they are actually translating through to deaths. So if you look at the number of deaths per million population in a place like Belgium, it's north of 1,000 per million. And it's not just the European countries that are being impacted by this. Look at Peru. The actual number of deaths per million is over 1,000 in Peru as well. We're running, just for comparable purposes, we're sitting at around 337. Now this week, we've had the whole story about a vaccine that really boosted the market, and it's Pfizer are the guys that have come out and said that they have this vaccine that is 90% effective. Well, it could well be 90% effective and may be effective in time, but there's some huge practicalities that the market maybe didn't really take into consideration. This particular vaccine has to be stored at -80 degrees. So let's just put that in context. That is way colder than the average annual temperature at the South Pole, and is about as cold as as ice cream or frozen steaks are shipped at. So to get this vaccine into various parts of the world in the frozen state, and to get it to the entire world's population, one of the analysts which we rate at HSBC has estimated it would take the equivalent of 8,000 Boeing 747s to distribute this virus globally. That is a huge number of planes. Obviously, they're quite free at the moment because there are not many people flying, but the practicality of getting the vaccine into markets is something that we think about when we hear that vaccines are being developed. So those are a couple of the themes that we've been thinking about. Murray's going to talk through the domestic view, and I'm going to drive the slides.
Just the results of our little poll that we ran earlier. Glad to see all of you are paying attention. So the Democrats coming out ahead at 68% versus an estimated 32% for the Republicans. So potentially a blue wave in the running, according to our poll.
I think that's what we hope for.
Yeah, so there's a lot of hope, in that one.
Right, Murray, over to you. I'll drive the slides.
Thanks, Rhino. Morning, everyone. If we do get a blue wave, it'll be extremely positive. 3 trillion of fiscal stimulus, a much weaker dollar, and the rest of the world will perform pretty well. Domestics in particular are going to have a pretty good time, we think. So firstly, I'm going to have a look at the domestic index. We have shown this before quite a few times, and this is the PE multiple for domestic South Africa 2 years forward. And it's the banks, the insurers, domestic industrials, and the property companies. And you can see that historically we've traded at around a 10.5 2-year forward multiple. You can see that at the bottom right-hand side, a little bit of a pop recently. So we're now on a 9 times 2 years forward earnings number, and that we think is sort of normalizing earnings. So we think we can quite easily, notwithstanding the weakness in the economy, sort of negative GDP of about 8 to 10 this year, bouncing back only about 3 next year. We think that could get back to above 10.5, 11. If we do have risk on, we think that could go quite a bit higher than that. And we have seen in the last, I mean, obviously this month to date, a lot of these domestics have rallied probably 15 to 20%, banks, insurers, and there could still be quite a way to go. They are very cheap in our view, and that's a theme we've been punting for a while. Next slide, Rhino. Okay, Rhino and I are trying to be in sync here, but it's quite difficult, Joburg to Cape Town. The other thing that obviously is everyone is extremely negative. We had the currency that got to 19 to the dollar, and in basically in April this year, and we were all the way back to 1550. This goes back since democracy, and it shows the percentage change over the 200-day moving average of the currency. And you can see there've been 4 periods where the currency has really blown out. The dot-com bubble in 2000, the financial crisis 2008, we say Nenegate, and recently. And you can see how currency spikes and then invariably it overreacts and it comes back. And that is what is happening at the moment. So we're back now to 1550. On a PPP basis, you could argue that the currency gets around today, that's probably around just over 14 and a quarter. We're not that bullish, but one shouldn't be surprised if we see it down. If things are really good, risk remains on, you get the blue wave. It's not impossible to see the currency back at the 14.50, 15 buck levels. Our call 1 year out from now, because longer term, we do think the fundamentals are a problem. We do have 17 against the dollar. So that's a weak dollar is going to be pretty good for a lot of people. Firstly, we just look at commodities. So this is a chart on the top chart. There's against a CRB commodities against the currency, and you can see how closely correlated they are. So weak dollar, commodities tend to rise, and at the bottom it's the same with oil. So not quite as close correlation, but a fairly decent correlation. So generally, weak dollar means that commodities do okay. Next slide. And then what does it mean for emerging markets? That's the next thing. Generally, global growth, weakening dollar. Dollar tends to weaken when we have strong growth. We have a V-shaped recovery. We think that global growth is around 4 next year. Maybe it's even stronger if the virus thing seems to be coming slightly earlier than expectations, the vaccine. And that will drive, again, you can see recently on that chart in the last year, how there's been a pickup. Dollar's weakened, and you can see how EM has sort of strengthened quite a bit. So weakening dollar is good for EM, and that means it should be good for SA.
I mean, just pointing out on this chart that the weaker dollar, obviously, inverted the dollar index. So when it's going down, it means the dollar is strengthening, and when it's going up, it means it's weakening, and that's the correlation Murray's talking to.
Okay, so what about positioning in emerging markets? On the left-hand side, we go back to 2008. The top line there shows EM's weight in the FTSE World Index. And that sort of 2008 was 11%. It's still around 11%. So that is a weighting of EM in the index. And it's really been helped by China and Asia that has got bigger and bigger in the EM index, which is a good thing for EM, I guess. Then you look at the line below shows basically in 2011, it shows EM weights in global funds. And 2011, we were sitting at 11%, and that has dwindled as we've moved forward to recently to around 5%, 5-6%. So EM weightings of global funds is very underweight. It's been an underperformer, and if you do get a swing around, there could be a lot of flows that come back into EM that could help drive the EM index in the next couple of years if we get rebound in economic growth and a weakening dollar. And on the right-hand side, we just show the cumulative flows into EM equity funds. Also, each line represents a year starting in 2016, but to focus on the 2020 line. So year to date, there's been $50 billion net out of EM. You can see that it has stabilized in the last 3 months. That line is flat now. And if things start turning around, we could have some decent flows into EM. So we think on balance of probabilities, we think EM's probably in for a fairly decent ride in the next year or two, is sort of our house guess. Or next one, Rana. Okay, this is quite a complex slide that we've derived and used for many years. So just very briefly, the top line is an earnings relative. So what it shows is domestic South Africa against the MSCI Emerging Market Index. And so the top line is 100. And what has happened there is South Africa's underperformed on earnings consistently from 100 down to 67 over the last 5 years. The middle chart is the rating. So it's a PE relative. So it's the PE of SA over the EM index. And you can see as well, we used to trade at parity. 1 is the middle line. And currently we're at 0.8. So we're at a 20% discount. And then the bottom line is a price relative. So I won't go into that. So we look at a lot of stocks on this basis in our fundamental analysis. So we've just done this for the index. But all it says to us is earnings have underperformed. It's starting to flatten out in SA currently, and the rating is pretty cheap. So if you re-rate and the earnings start to relatively underperform, which we think could happen over the next 12 months, domestic SA probably doesn't look too bad, and we could have a period of outperformance in the short term anyway. Next one, Rana.
Just while I'm on this fixed income slide, just to encourage people, if you do have questions, to pop them through on the Q&A line, and Murray and I will cover those when the presentation is done. We do aim to leave a few minutes for presentation for questions. I should have mentioned that at the start of the presentation.
Okay, so on this chart, we've got also quite a few lines on here. But basically on the left-hand side is the foreign holding of SA government bonds. And we go back to what has that weighting been. Each line represents a year changed, starting in 2013. And historically, foreigners have owned in our market probably sort of 33% to 40% of all our bonds. That's where liquid market, bond market, and a good representation for EM. If we focus on this recent year, and that is the red line over there, it started off beginning of the year at 37%. That has gone all the way down to 29%. Foreigners now own only 29%. So there's been a huge outflow big amount of bond selling in South Africa since our downgrade. And the question is, how far down does this go? So we've actually had about 85 billion Rand has flown out of our bond market since the beginning of this year. But the interesting fact is month to date, and I was sort of speaking to guys on the bond desks yesterday, we've had 16 billion Rand has actually come into our market, into bonds. And you've seen this tick down in bond yields that has happened month to date. So with this risk on, there's been quite a big change. Where that settles, that the number is, obviously it's going to go up for the end of this coming month, but we think around the probably a reasonable level is probably about the 27-28% level for where foreigners will settle at. What has been quite interesting though is the banks. Banks also hold a lot of bonds on their balance sheet, and that's on the right-hand side, and also showing the different years, their weightings. Generally has been between 13% and 17%. But if you look in the current year, again, the red line, we've moved up from 17% to 22%. And what's happened is banks have become quite awash with liquidity. People, the deposits are huge and they're having to put the money somewhere, and credit growth is not that strong. So they've been buying into the bonds. So they generally go sort of short term, the R186s, maybe the 10-year bond, but mainly shorter dated. And then they swap that out into floating rates. So it has picked up quite a lot, which is quite an interesting trend that's been happening in the bond market.
Yeah, I think it's also they've mopped up quite a lot of the issuance that's taken place by the government. You know, they've not only bought bonds from the foreigners, but they've effectively mopped up issuance that has taken place in that bond market. You can. Yeah,
because basically there's just, they don't have places to put all this excess cash that they're getting in there, and they can't put it out. So there's quite a decent turn. They get about a 1.5% pickup in yield by doing that and by swapping it out into floating rate. Okay, so what if we look, I mean, this is always a shift in the yield curve. So this just shows the bond curve. We have the beginning of the year where we were. It's quite interesting to see at the 1-year rates at the beginning of the year was at 8%. If you look on the left-hand side there, Ryan, if you just point to it up at the top. Yeah, so that's where you were beginning of 8% was a pretty decent for 1 year money. And that's why a lot of people were in money market funds. That rate has dropped right down with rates globally dropping and obviously our interest rates here. And you're right down now to 3.5%. So the yield pickup is not much. And those that aren't in the market at the moment must be crying a bit because you're not getting much on cash. If you're sitting on cash, I guess we've seen a lot of people saying now, well, with the currency so strong, let's take all the max money we can offshore. So there's been a lot of money flowing out, particularly at these rates. But rates are very low. And I think there's a chance at the MPC we could get another rate cut because inflation is very much under control. If we move down the curve, and obviously the fiscal situation of South Africa has deteriorated significantly. Debt to GDP is probably going to be, well, estimates by government, sort of 95% in 2024, 2025. I think there's a chance that it could be worse than that. We could pop through the 100. And if you add the parastatals in as well, it's probably sitting close to 150, 120. So, but at the 10-year, our 10-year now at 9%, it's a little bit lower than that, I think, this morning. But at 9%, it's exactly the same spot it was at the beginning of the year. And what has happened? So short rates have come right down in the curve. And at the back end of the curve, because of the worries about the fiscal situation, we've picked up sort of just under 100 basis points across the curve. So we've in the flexible fund, in fact, the 15-year, 2035 is where we've been playing. That's been we think where there's pretty decent yield pickup. And with the rally in bonds at the moment, I mean, month to date, you've almost got a 6% return from that area of the curve. So we do think our projections are 1 year forward. We are just expecting rates to be at the shorter end, 10-year to be around 9, and at the probably the 35 level, we'll still see some compression in our view. Next slide, Rana. Okay, this is very briefly some of our forecasts going forward. World growth -4 this year, going up 5% next year. SA -8 +3. And then thereafter, very modest growth. Bond yields, we talked about 9%. Currency dollar-euro, we think that goes out to 125. So weakening dollar, which should be good for commodities and SA Inc. And then our rand, which we talked about, we think 12 months out from now, around 17 or so. Next one.
Quick poll, just based on what Murray's been through, with interest rates having come down so substantially, are you guys looking at potentially increasing your risk within your portfolios, or are you sort of holding your positions currently?
Okay.
Rana, next. Okay. All right. So very briefly, we've talked about on the webinars that we've had before, Rana and myself, various funds. I mean, we just want to sort of the flexible fund, which we're going to talk about, that's been going, I guess, in the long only space. It's our longest fund. It's been going now 7.5 years. We started that out as sort of very much sort of trying to get CPI +5 was the objective. And then also to try and sort of beat the Aussie, or let's say cap Swix probably is a better measure over time. That was the objective of the fund. And so I guess, and the flexibility coming from a hedge fund background. Interesting, you'll notice if you looked at, and it's been pretty tough the last few years. Look, last year we did 9%. We have compounded return at 9.7% to the end of last month, versus Aussie of 6. That's done well. And we had to obviously put in how we were doing for months to date, seeing it was so good. As of close of business of yesterday, the fund's up 7.6%. So it would take it above 10% compound. And it also obviously makes it positive for the year. So we had to just slip that in there.
Thank you. Cursed us, Murray, by putting that in.
No, not at all. Not at all.
I blame Murray.
Okay, next slide. Okay, so this just puts in perspective. It's been pretty tough in equity markets the last 5 years. So if you look at the all shares done 6%, cap Swix done 5%. So, and inflation's been 5%. So for 5 years, basically, if you match the index, and the index has been driven by the top 5 stocks. If you look at the Naspers, Richemont, Anglos and Billiton, it flatters the numbers because most stocks are well down. But anyway, so you've been looking at around 5%. You can see well, right now we're pretty much in line, I guess, right now with CPI plus 5. Next slide.
See. Okay.
And
Sorry.
I'm trying to keep up here. Brain's not working that fast, Rana.
Have you used the keyboard?
Okay, so then what we thought is, let's just put, it's interesting to know that the average equity fund over that period, 7.5 years, has done 5%. So that's in the middle. And the best performing equity fund over the 7 years has done 12%. Look, it's 7 real, but it's not like the heydays in the 80s, 90s, early 2000s, I must say. But so the flexible fund has been pretty decent relative. I mean, in fact, it would be the second out of all the equity funds. It'd be the second best equity fund. There's only one fund that's better over this period. Next one. Okay, so then what we do is also say, well, what about the risk? What risk do we take in this? What risk do you take in this fund? And we've run on average about 80% in equities, about 5% in property. So 85% risk assets. And then we've just played around when bonds look interesting. We put a little bit of Africa in every now. Offshore has been up to 15%. With hindsight, we probably should have put more offshore, but we haven't in the fund. But it's been okay. So just below 10% return with a vol of basically just over 10%. You can see the Aussie and CapSwix, which vols run at about 13.5. So on a risk-adjusted basis as well, it's a pretty decent fund to be in the flexible fund. Higher equity than our high equity balance fund generally, but also the flexibility to move around and push the equity up if we really like things. So where were we at the beginning of the month? Our equity component, we're running at 81% beginning of the month. So that would have gone up with the moves in the market. And 17% offshore. Fixed income, we talked about it. We have in our Africa bond fund, we have about 3% in that. Running yield of, in dollars, you're getting about 7.7%, which is quite decent. And our positions, I guess, if we look at Naspers, which is under a bit of pressure, we'll talk a little bit about. We have, Rana mentioned, we shifted from the S&P into the Russell Value Index. We got 5.5% in that. We think that outperforms more the tech stocks and the S&P going forward. MTN, which has popped its head up quite nicely beginning of the month. That's up 23% month to date. MTN, Anglos is up about 15%. ABSA banks, we're also very bullish, have been. ABSA, Standard Banks are also up about 20% this month. Next slide. And then I guess some of the smaller caps as well we have in there. We've got a bit of Hudayco, which is quite well. Distill, which is doing pretty well. We have some transaction capital that has done quite well. Just very briefly on the banks, we've gone on about these banks. We think the banks are just way too cheap. We have a very big overweight in our equity funds on banks. Probably 17%, and we're starting to see these banks move. And we've been long suffering, but you can see this month. I mean, something like Nedbank's up 30% this month. And if you look just on the bottom left, price to book, ABSA is still only a 0.8 times price to book. Historically, they're at 1.4. All we are saying is 1 year out, we reckon it sits at about a 1 times price to book. Nedbank's was 0.6. We think that should be 0.9. Nothing like they used to be. So we still think, even with the weak economy, the banks have got a lot more upside. And they're not going to have to raise capital. They will resume paying dividends, we think, mid next year. And the dividend yield should be good. Just one slide, a last slide, in fact, is to talk on Naspers. You can see what's been going on with the regulatory side in China at the moment. With the Ant listing that was delayed, Jack Ma causing a few problems there. And the regulatory, at the moment, there's a bit of regulatory risk around there. And we've seen Naspers process coming off, and there's quite a few of the tech stocks. Alibaba down, Meituan down, huge falls in these stocks. Long term, we're still very comfortable on Tencent. On the left-hand side, you can see it's listed associates make up 24% of the market cap. If you strip those out, it's trading a 17 multiple, growing at 20%. And then if we look at Naspers is trading the discount on the right-hand side, 50% discount to some of the parts. And the company has announced buybacks, which start in 2 weeks' time, $5 billion between Naspers and Process. And we also think that Naspers will unbundle its Process stake of probably 23% of its stake within the next 3 to 6 months. So we still think it looks very attractive. It is the biggest stock in the market, but we're still very upbeat on that. So that's our summary. I guess domestic, if we get the blue wave, hold on to your seats, because I think it could be really good. I like to see everyone expecting that, but the odds of winning both there is going to be quite tough. But even with Biden and no blue wave, I think it's quite decent, and our valuations are good. The dollar is very likely to weaken, we believe, which is good for EM and should help the SA Inc. commodities and SA Inc. So hopefully we're in for a decent year into next year. So now let's go back to questions. I think, Mike, you're going to moderate the questions. Thanks.
Yeah, I'll just share the results of our last poll that we ran. You can see a majority of people are looking to increase risk, which sounds good in this environment that you've described, Murray. Some still on the fence and 1 or 2 still no. I do have one last poll, which I'll do in a bit, but let's have a look at some questions. I think, Mark, Liddy, we have answered that question initially just around the flows regarding foreigners in equities and bonds. I'm going to move on to Joe's question. Do you see SA outperforming the emerging market baskets? Perhaps for you, Murray.
Yeah, look, I think the first thing is, of the EM index, you have Asia is very big, and fundamentally long term, I think Asia with China and the rest of Asia, I think SA is not going to outperform. So fundamentally long term, no, we're not going to outperform. But I think some of our stock, if we look in the shorter term, if we look over the next 6 to 12 months, I think it's quite possible that we could, because everyone has been so negative on South Africa Inc. that and we bounce back valuations, we could perform quite well, particularly the domestic side. So I would go, if 6 to 12 months, I think we'll outperform. I think that, but on a longer term basis, I definitely wouldn't back SA against the rest of EM because of the big weighting in China and Asia.
I'd agree with that.
Cool. Thanks, Murray. From Jared, maybe dovetailing into that question, how would you factor rand hedges in the SA compared to emerging markets? Is the price and valuation differences justified given the weak fundamentals?
I'm not exactly sure how to interpret Jared's question. I think that from a rand hedge perspective, there are 2 components in of rand hedges. So let's just separate them out. They're the rand hedges, which are the commodity-based rand hedges, which derive most of their earnings from, I guess, non-rand sources, selling platinum, palladium, etc., effectively in dollars. And then they're the international stocks that just happen to be listed on the JSE. On that, in that respect, I'm thinking of companies like British American Tobacco, Anheuser-Busch, etc., that happen to be listed here. And then from a portfolio construction perspective, we spend quite a lot of time understanding the drivers of the portfolio. So we will put into various buckets the dollar driver, the emerging market drivers, the pound drivers of our market, and seek to balance those out over time. And clearly the rand hedges have performed particularly well, as I showed in, I think, the second or third chart that I put up, and have done very well for us in the short to medium term, primarily driven by the commodity side of things. So the commodity growth that both Murray and I talked to is kind of aside from the South African weak fundamentals. You can still have great performance in those commodity companies, even with weak economic environment in South Africa. I don't know if that answered Jared's question. Jared, you're welcome to give me a shout afterwards if you want, and we can run through it in more detail.
Thanks, Rana. Travis's question, I'm just going to summarize a bit, but basically, do we see with the weakening dollar prospects that the US is a good place to be investing, or in fact in the dollar itself? Murray, for you.
Yeah, so look, the S&P has had a phenomenal, has performed extremely well over the last decade. If you go back the decade before that, it actually did close to zero. So tech's been the very big driver. And I think while longer term tech will do very well, I think if we get a rebound next year, well, rebound V-shaped recovery next year, if we get this additional stimulus coming in the US, it's not going to be, we don't think tech's going to be the place that's really going to outperform. And that's why we've moved into the value side. I'm forecasting currencies, we're not hiding to nothing. But I mean, I think that if we look on, if you take an MSCI World Index, we think that with the rebound in economic growth, probably the US, the S&P is not going to, is unlikely to be an outperformer against, it is 55% of the World Index. But if you're just to track it against the World Index non-S&P, we think there's a good chance over the next 12 months, it's the emerging markets do well. China probably still does well, and tech doesn't do that well. But longer term, we still think fundamentally that tech is good.
Thanks, Murray. From Duncan, what catalysts do you potentially see for SA equity and SA equity market uptick, or is it really a function of the blue wave? Maybe for you, Brian.
I think, as we said, a blue wave would be very positive for emerging markets. And I think just to make a point on that, when we say it's positive for emerging markets, South Africa gets dragged along with the rest of the emerging markets. So if it's positive for emerging markets, it would be positive for South Africa. And I think, you know, to answer the question, that there's some sentiment change can really drive this market as well. You know, if we do start to see, and I've said it a number of times, and I keep on saying, if we start to see people in yellow uniforms or orange uniforms, you know, running around. In fact, you know, people being arrested is what I'm saying.
Hopefully not running around, Rano.
They won't be running around. They'll be gardening at Polesmore when we drive past. You know, that I think would be quite positive, and I do hope to see some of those arrests take place. And I think then, as Murray demonstrated with that value guide, which is the tool that we use often at Laurium to ascertain whether there is value in stocks and indices, etc., we've derated so significantly relative to other emerging markets and relative to other developed markets that it's like a coiled spring. The valuations are so low relative that any bit of good news you can have a significant rebound. I mean, we've seen it in a couple of companies. I mean, you know, you've seen it in some of the domestically orientated South African companies that have just shown a little bit of good news in their results, and they have shot upwards. You know, there have been a few examples. Shoprite was one, Pick n Pay was another, Motus was another. So there are a number of those things that could be catalysts. And then one final thing just to throw into the mix, what we've started to see is some international companies buying into South African companies. So a good example of this is MultiChoice, where Vivendi has started to build a stake in MultiChoice, we think, to try and evolve Vivendi's programming and effective DSTV services that they have in Francophone Africa, to add maybe MultiChoice's African business to theirs to grow the African exposure. We're also seeing interesting things like a big Saudi company which has a cat dealership in Saudi buying into Barloworld. If you start to see more of that coming through, that also could be a catalyst. So sorry, a long answer, but I think there are some positives in the market.
Thanks. A good question from Joe regarding China and the tech companies. It's probably something which we were talking about this morning in our meeting. Are we concerned about what's happening with China in terms of the regulations of the tech companies?
You're handing that to Murray.
Okay, shall I? And I actually needed to.
Go, Murray.
The answer, Joe, is yes. Yes. So Dwayne had a long explanation, who looks at Tencent on our side, from our side. And it is a concern, I guess, that the structures of the holding, how Tencent is held by Naspers, it's quite it's difficult structures it's held through Hong Kong. It's not a straight holding in. So there's a lot of nuances around that. So that is quite an issue. His view, and he's been speaking to IR yesterday on this, They think that there shouldn't be an issue, but you always got to worry a little bit. But regulation for tech companies has to pick up. We're seeing it in the States, and I think that just will increase anyway over time. Just to what extent is difficult to know, but it has to. And then China as well. Some of the stuff that's come out was in the wings basically beginning of this year. But I think when Jack Ma made a few comments on the listing about the regulations, the capital requirements on lending for some of the companies, particularly the Ant Group, there was some issues. According to Dwayne, I mean, some of the companies that are way worse off than a Tencent there is, he thinks it's a lot worse off for the Ant Group, and then Meituan as well, and some of the food delivery businesses as well in China. But yeah, it is a concern, but we think that things will tighten up, but in the long term, it's not going to affect Tencent's view. But we have seen the stock off quite sharply, probably 15%. It's probably small down on the month to date, but it has had a very big run.
Great. And
we can, Joe. What I'll do is I'll get Dwayne to give you a buzz, because he'll give you a lot of detail on that. I'll get him to give you a buzz afterwards. Yeah.
A last question from Mark, unless anybody has any other questions. Why have foreigners reduced SA bonds when our yields are so much higher than other countries? You did touch on this, Murray, but maybe you can explain.
Well, I'll start, and maybe Murray can chip in as well. I mean, I think firstly, obviously there has been the downgrade. So it's kind of weird to think that happened this year, but it was this year that we exited the WGB on the downgrade. So there has been a bit of natural selling as a result of that that downgrade. And then I think, and obviously I don't fully know the minds of the foreigners, but in speaking to some of the guys that I used to service when I did a different job and spoke to foreign clients, a lot of them are concerned about the issuance. They're concerned about the fiscal structure of South Africa, and the fact that we're going to need to issue more and more bonds, more and more debt to fund the future of the country. And I think that's probably the thing that is most central to the guys selling out of the bonds over the course of the year. So the two things: the downgrade forced them to sell, and then worries about issuance. But as Murray was saying earlier, this month, as risk has come back on, you've seen the foreigners come back into both the equity and bond market to take advantage of those very juicy relative yields to what you're getting in the developed market space. Murray, I don't know if you have anything to add.
Yeah, look, I don't think too much to that, other than to say, look, people are concerned further out. Are we going to get into debt crisis? Our funding costs are very high. We're funding at 9-10%, and the debt burden is growing. So how do we get out of it? The only way really is very strong growth. And if you don't have that happening, then it could potentially become an issue. And that's why as you move out literally further down the curve, when you get 7 years plus, the yields pick up a lot, and people are concerned. But if there's risk on next year and search for yield, those bond yields will come down. It's just flow of money back in. And then we'll worry about the 5-year situation or 10 years. It's going to take a long time. We could always debase the currency, I guess, is the one way out. And because fortunately, we don't have a lot of foreign bonds. So there's not an issue other than the currency would be the release valve, maybe in 5 years' time, if there is a big issue.
Great. Thanks, Murray. And thanks, everyone. That's just the last little question poll session there. It's great to see that some of you are considering using Flex as a building block, and those who haven't considered it, hopefully we've given you some food for thought, and that the feedback on the US elections has been useful. If you've got any questions for us, feel free to email Kim or myself, or to get in touch. But yeah, thanks for your time this morning.
Yes, thanks everyone. And I think particularly thanks to there've been some, over the course of these various webinars that we've done, there've been some consistent people that have been very engaged with them. So thanks very much to, I think, Mark, Lydia and Joe. They've probably asked the most questions. I think we should maybe send over a bottle of wine to thanks for the support over the course of these webinars this year. and yeah, hopefully get to see you guys in person at some point. But thanks very much for listening to us.
Thanks, everyone.
Thanks,
Have a good
guys.
week further.